Thank you. I'll start the webinar. I'll present my screen. Good afternoon to all. My name is Hunny Munjal. I'm a chartered accountant by profession. I have worked close to 8 years in the field of indirect tax, which is GST and customs. I worked with two of the big fours, PwC and KPMG. Now, this is a brief background about myself. Today's topic for this webinar is EPCG and Advanced Authorization Scheme. These are the two most important schemes under FTP, which is Foreign Trade Policy, and which governs also under the custom law. These two schemes are very important for any exporter so that he can take the custom duty benefit and he can take IGST and compensation benefit as well. So there'll not be taxability with respect to custom duty and IGST. There'll be exemption with respect to IGST and compensation cess on its import, as well as in one of our scheme, there is a benefit or there is an exemption with respect to GST on the domestic procurement as well, which is indigenous procurement. So these two schemes are very important and very helpful in case you are an exporter. And this topic can be a very useful for a person who is employed in an export oriented company or who is a consultant who's providing services to a company which is engaged in export of goods from India to outside India. Because these two schemes can be helpful for them to take a benefit or take an exemption with respect to custom duty on their capital goods as well as on their raw material, which substantially reduce their raw material or their cost of the product. So hence, these two schemes are very important for any person who is directly or indirectly associated with a export-oriented company. I think these two schemes can be usable for them. We will dwell more. We will understand the nuances of it in this webinar so that we can understand the scheme, we can use it for our purpose. What are the benefits under the scheme? What are the conditions as an exporter we have to comply with? All these aspects we will discuss in next 1 hour in this webinar. So probably we have to understand more on this. I'll take you to my agenda. Agenda of this webinar for next 1 hour would be understanding these two schemes, which is EPCG scheme and Advanced Authorization Scheme. First, we will understand what is this EPCG scheme, what benefits under this scheme government is trying to give it to the exporter. How can I use this thing? All these aspects we will understand in introduction. Then probably we'll understand, okay, what is the validity of this scheme? How long this benefit is available to the exporter? Operational conditions. And there is one more aspect which is installation certificate, as these are capital goods. So we have to comply with these. So these are compliances, which if you are an exporter and you have taken a benefit under the scheme, you have to comply with. If you are not complied with, there are late fees, there are penalties with respect to this non-compliance. Then probably we'll understand export obligation. What is the export obligation on an exporter if he has taken a benefit under this scheme? What are the compliances? Documentation. As a person who is taking a benefit which is given under the scheme had to maintain these documents. What period I am required to maintain these documents? All these nuances with respect to EPCG, we will discuss it. Now we will understand the next scheme, which is advanced authorization. How different is this scheme from EPCG? What are the main difference between EPCG and advanced authorization? And then, being an exporter, can I claim both the benefits? Whether it's a both the benefits I can claim, or it's only one benefit under one scheme I can claim it. This also we will understand. And next, which is pre-import condition. This topic has also reached out to Supreme Court. On this, there are two contradictory High Court judgment on pre-import condition, and then it has reached to the doors of Apex Court. And what Apex Court has rendered in this context, we'll understand about pre-import condition and what Apex Courts provide this, how the court interpret this. Then the last would be general provisions with respect to advance authorization scheme. Now, as I've told you, there are two schemes. I'll take you to first scheme, which is export promotion capital goods. As the name himself very clearly says, this is for the purpose of capital goods. If you are an exporter and on your import of capital goods, if you are willing to take a benefit under export promotion capital goods scheme, then you can use this scheme. As the name also says, export promotion. So this is for promoting of the export. If you are in the business of export, and the government by this scheme wants to encourage exporter to do more exports, bring more foreign exchange to the country, and in exchange of that, the government is giving capital goods benefit. How these government is giving the benefit, that we discuss in this part. Now, the first bullet of my first slide is key feature, or I can say key benefits under this scheme. The first point says zero custom duty. If you are an exporter and you have opted for EPCG scheme on your import of capital goods, there'll be a zero custom duty for for importing of the capital goods. And these capital goods can be used for pre-production, production of the goods, export goods, and post-production. Post-production would be packaging, other things. All these machinery, if you are importing from outside India and you have opted for EPCG scheme, on that your custom duty will not be applicable. So there'll be a zero custom duty on that. Along with that, the government has given IGST and compensation cess exemption as well. So first benefit was zero custom duty. Now the government has given one more benefit saying that no IGST or compensation cess would be applicable on the import of capital goods. So both are being given. The only condition is if you export the goods from outside India. These are the two major benefits under the scheme. One more, which is the cherry on the cake. In case this scheme is not only for imported goods, but this scheme also extends to domestic procurement also. What do you mean by domestic procurement? In case uh, an exporter wants to locally procure the capital goods, that exporter also get the benefit of IGST and compensation cess exemption. So there are biggest benefit under this scheme. First being custom duty is not applicable, so there is a zero custom duty. IGST compensation cess is also not applicable. The third one, in case you don't want to import from outside India, still on your local procurement, the GST would not be applicable. So this is a very important scheme for any exporter who is willing to procure a capital goods. We can use this, but it comes with own challenges. It comes with its own compliances. I'll not say challenges. It comes with own compliances. As an exporter, if you are availing a benefit under the scheme, so there are number of compliances you have to comply with. We will discuss that in next slides on this and in this slide. First, who are the person who can apply for this scheme? Firstly, manufacturer. If you are a manufacturer, exporter, and you are engaged in the export of goods, you can take a benefit under this scheme. The next one, merchant exporter tied to a supporting manufacturer. If you are a merchant exporter and you are tied to a supporting manufacturer. Now, the question here comes in, what is a merchant exporter? Just to give you in a very simple layman language, merchant exporter is a trader who procures from India and he export outside India. He's a trader, I can say in a simple layman term. But in a legal term, we call him a merchant exporter who procures the goods from supporting manufacturers and he in turn export outside India. Then in that case, he can also take the benefit or manufacturer can take a benefit of EPCG scheme, provided on its export, the shipping bill carries the name of the merchant, carries the name of the supporting manufacturer along with merchant exporter to evidence that indeed the goods are being manufactured by the supporting manufacturer and then merchant exporter has exported these goods from India to outside India and there is a foreign exchange being realized by them. So first two person who can take the benefit of this scheme. The third one, which is a service provider. If you are a service provider and you are in the business hotels, tour operator, logistics companies, who in turn who generate a foreign exchange, then only you can take a benefit of EPCG scheme provided you generate a foreign exchange. And then you can also import goods without custom duty, without IGST compensation cess. So all these benefits would be available to you in case you are generating foreign exchange because all these schemes are meant to increase the foreign exchange and reduce the cost of the exporter. Now, what are the capital goods being covered? Machinery, equipment, tools, computer systems, software, integrity capital, spares, if you require spares, molds, dies, jigs, fixtures, refractories, catalysts for initial and subsequent charges. All these machineries, all these products, if it's a capital goods for you, then you can import taking the benefit of under the scheme, which is zero custom duty and IGST and compensation. Also, these can be prepared locally. Now, there is a list of items in Appendix 5F, which is a negative list. You cannot, if you are importing or domestically procuring these goods, you cannot take a benefit of this scheme for these goods. But majorly, if you are importing a machinery, which will be used for the manufacture of goods, which will be in turn exported from India to outside India, you can take a benefit of this EPCG scheme. Now, the government has given you a benefit. Now, there will be an export obligation. Now, this is your duty saved or your taxes saved. The government has came up saying that you export the goods. How much is the export they expect? Which is six times of the duty, taxes, cess. This duty would be custom duty, taxes, IGST, compensation, cess. Whatever amount you have saved, six times of that you have to do an export obligation within 6 years. So there is a six. Whatever amount of duties the government has not levied on you, you have to multiply by six times. You have to do an export obligation within 6 years. So this is a very important point for any exporter who is willing to take a benefit of this EPCG scheme because he had to in turn export the good from India to outside. Now there is an average export obligation. He had to maintain an average export level of preceding three licensing levels. I'll shift to my next slide, which comes with a title Validity, Operational Condition, and Condition for Installation of Capital. Let's first understand the validity of the scheme, validity of my authorization, validity of my license. So, my license to import these goods would be valid for 24 months from the date of issue. So, if you have got the license or the authorization to import on 1st April 2025, your authorization would be valid for 2 years, which is 27. Till 27, you can import it. So it is valid for 2 years. And also, the government has came up very categorically, no revalidation. You cannot revalidate again. It's a one-time 24 months for one application. And then if you want to make another application, take another file another application that will be valid for 24 months. Now, as I was mentioning in the last slide, you can take a benefit under the scheme for domestic procurement of capital goods. So, as per the GST rules, as per the GST law, the if a person is supplying a goods to a person who is registered as advance authorization, the supplier, whosoever supply makes, would be called as a deemed export under notification number 48 by 2017, and he can get the refund of the GST being charged on them. So if you are domestically, which is indigenously, you are procuring some goods or capital goods, then the supplier under the GST law by notification number 48 by 2017, all his supplier to you would be considered as deemed export, and he can get the refund of the GST charge on them. In case he is not willing to do that, as a recipient, as a person who is registered under advance authorization, you can also claim the refund. He can charge your GST and you can claim a refund of the GST charged on invoice under Rule 89 4B of the GST. So either way, the government has given both the options for domestic procurement. Either the supplier wants to charge it, he can charge it, and his supplier would be called as a deemed export, and he can get the refund of it. In case he is not willing to do that, as a recipient of the capital goods, you can also offer a refund of the GST charged on it. So both way, the government has tried to give you options if you want to avail the benefit of the advance authorization. But it comes with its own compliances, which earlier we have understood. There's a export obligation, which is 6 times of the duty charge or the taxes charged within the period of 6 years. Now we will understand more conditions of it. So the government has also said actual user condition. Whatever capital goods you have procured, it has to be used by you only. You cannot sell it. You cannot just sell it as you have got the benefit. You just sell it and you got the money. No, you cannot sell it. Even you cannot transfer it within 5 years of the date of import. So you have to first meet the obligation, export obligation, then only you can transfer. So it is a very actual user condition. You have to use these goods yourself for the production of export goods. Now, as the government has given you benefit, they can always call the details document, and you being a recipient of the benefit is mandated to submit the document details to the tax authorities within a timely manner. So this is actual user operational condition. Now there is a very important point with respect to installation of capital goods. Now this being a capital goods, the government wants a proof of installation of the capital goods. They don't want you take a benefit and then sell it off. So for to curb this practice, they have come up with installation certificate from an independent chartered engineer or judicial custom. Within 6 months, you have to obtain a installation certificate, which evidence that indeed these capital goods have been installed in your premises and you are being used. And that had to be done within 6 months of the date of import. In case you don't apply it, there's a one-time extension with a fee of 5,000. Post this, judicial officer can verify your premises and he can check whether indeed the capital goods have been installed in your premises or not. In case you want to move these capital goods to one place to another place, from one place to another place, you can do that during the export obligation. But same condition, you have to obtain an installation certificate within 6 months of the date of shipping, so that the government is confirmed that indeed these goods are not sold and these capital goods have been used by you for the export of or manufacturing of the export goods. I'll take you to the next topic. Now, export obligation. We have discussed very small part in our previous slides. Now we will understand more on this export obligation in this slide. What are the compliances and documentation? Now, first the export obligation. As I've told you in my first slide, the export obligation comes to around 6 times duty saved cess on your capital goods, which had to be fulfilled within 6 months. Now, in this scheme, there is a concept called block-wise fulfillment. Just to easen up the exporter to export the goods, the government has came a 6 year period. You can discharge your 50% export obligation within 4 years, first 4 years, and balance 50% you can discharge in fifth and sixth year. Because initially the goods would require a timeline, goods would require a little time so that you can sell it. So the threshold is lesser, 50%. And in balance, once everything your business stabilizes, you can do an export and you can comply within fifth and sixth year with respect to balance of goods. In case you are a very good businessman, you are a very good exporter, and you are able to fulfill the 75% of export obligation within 4 years. Within 4 years, you are able to do that. The government gives a waiver of 25%. So, in that case, if you want to avail a benefit, you just complete the export obligation within 75%. Within 4 years, the balance 25% would not be required. So this is a very important point. If you are a business owner who generally export a lot of goods, you can take a benefit of this and you can comply within 4 years by just fulfilling 75%. Post fulfillment of the export obligation, you have to make an intimation to the regional authority and within 3 months of the block completion. And they will give you a EODC, which is export obligation discharge certificate, which evidence that as an exporter, you have complied with the export obligation requirement, and this is the evidence for that. For domestic procurement, what we discussed earlier in this slide, for domestic procurement also, this scheme can be a usable one. You can use this scheme. Now, in case of a domestic procurement, the export obligation is 75%. It's a little lesser because there is no custom duty in that domestic procurement. So the government has reduced the export obligation for 75%. Now, this is the export obligation. This is a very important point which we have to be very mindful. In case we don't fulfill our export obligation, we may have an interest and penalty implication as well. So we have to also government comes up with some kind of amnesty scheme always with respect to this export obligation as well. So we have to be very mindful that we comply with this export obligation. Now compliances, as this is a benefit given to you by the government expects that you file an annual return before 30th June of each year. And that annual return should provide all the details of export, all the details of supplies, all other details so that they can verify whether you have indeed complied with the export obligation, whether the goods are with you, how much is the time frame, whether 50%, sorry, whether 50% of the export obligation have been intend meet in 4 years or balance is 15 6. So there's a annual return which a exporter has to file before 30th June of each year. Now, what are the documentation? If as an exporter you are claiming the benefit under the scheme, you have to maintain. First, the most important, on your shipping bills, on your invoices, the EPCG authorization number should be very clearly have it written. On your shipping bill, if you are exporting goods from India to outside India, there should be a EPCG authorization so that the custom officers, the DGFT officer can verify that the export obligation, the exports have been made on the basis of this authorization. Now, you have exported goods of India from India, so there should be a tax invoice or a commercial invoice. Tax invoice along with the commercial invoice should be there for the export. If you have taken a lorry or transportation, there should be a proof of it so that to evidence that indeed these goods are exported from India to outside India. There should be a proof of money being received. If you have exported goods from India to outside India, there should be a receipt of foreign exchange because end of the day, the government wants to increase their foreign exchange. So they want a proof of it, whether you have indeed exported goods and then you have realized the money. This is the same condition under the GST provision tax. For getting the refund on export, you should have realized the money. You should have received the foreign exchange. In case you are a supporting manufacturer, you are a supporting manufacturer tied to a merchant exporter. Then on the export documents, your name should also be ingrained, should also be there on these documents, like on shipping bill, on export invoice. As a manufacturer, it should be mentioned that the manufacturer, these goods are being manufactured by this supporting manufacturer, and I being a merchant exporter. Now, there should be a true account of export and supplies and services being rendered by the exporter. So there should be a complete and a true and fair records of export and supplies. And all these records, along with other records, had to be maintained at least for a period of 2 years post redemption. So once you have redeemed the benefits, at least for 2 years, post 2 years, you have to maintain all these records. Now, there's one more condition which is bank guarantee. So there can be a requirement for bank guarantee which is equivalent to 15% of the duty rate. But in exceptional cases, if you are a AEO exporter, you are an authorized economic operator, you are a very big exporter. In such a cases, the government or the custom department sometimes waive this bank guarantee requirement, which is 15% of the duty rate. So this requires a little deep dive of the facts that what kind of a AEO you are, what tire 1, 2, 3 you are in tire stage, then probably basis there be a bank guarantee, requirement of bank guarantee, which is equivalent to 15% of the duty rate, can be waived off by the custom department as well. So this is the EPCG scheme, which is primarily for the capital goods. If you are an exporter and you want to import your capital goods from India, from outside India, or you want to procure goods indigenously, then you can use EPCG scheme along with complying with all these requirements. Now we will go to advanced authorization scheme. The basic difference between EPCG scheme and the advanced authorization is EPCG is for the capital goods, advanced authorization is for raw material, your consumables. So both, if you are an exporter, you can use both the schemes. So they can be used both. It is not that you can either use EPCG or advanced authorization. If you are an exporter, you can use both the schemes, one for raw material, which is advanced authorization, and capital goods, you can use EPCG scheme. So now my first point says my EPCG schemes provides the benefit of, is facilitate duty-free imports of imports, which is inputs, raw material, including consumable, which is fuel, oil, catalyst for the production of export goods. This scheme also covers manufacturer exporter and merchant exporter in collaboration with supporting or tied up to the supporting manufacturer. But the major difference here is you cannot use, if you are a service provider, you can use EPCG scheme, but you cannot use advanced authorization scheme. So this is the first difference between the EPCG and advanced authorization. This scheme was notified by notification number 18, 2025, custom dated April 1st, 2000, which provide a complete code for this scheme. Now, under the scheme, you can import raw material for the manufacturer of goods. Along with this, in this scheme, there's a definition for manufacture. What do you mean by manufacture of the goods is also being provided under this scheme. If your manufacturing, let's say you have converted the X raw material into a Y finished goods, it is covered under this definition, then only you can claim the benefit of this scheme. So the difference in this is there's a manufacturing definition. As an exporter, you have to comply with this. There's a difference between EPCG. EPCG does not provide any definition. Also, in EPCG, as a service provider, if you are engaged in hotel or transportation of goods, logistic business, and you earn a foreign exchange, still you can use a EPCG, but you cannot use advanced authorization. So these are the two differences as of now. Now we will understand the duty exemption. As we understood in EPCG, you have the BCD benefit, the basic custom duty, the IGST plus compensation. In advance authorization, you have only basic custom duty benefit, which is custom duty along with other custom duty, additional custom duty, education says, anti-dumping duty, everything which relates to custom duty is being exempted under the advance authorization scheme. IGST, which was available in EPCG, was also available in this advance authorization, but it was now done away. Now IGST is applicable. IGST exemption was applicable till 30th June 2022. So as of now, IGST would be applicable even if you are registered under advance authorization scheme. But if you are registered under EPCG for import of capital goods, you can have an exemption for IGST and compensation says both. But the difference here is it is not available in advance authorization. But custom duty is available anyway. So there are other duties with respect to NCCD, which is National Calamity Contingent Duty, education sense on NCCD, specific anti-dumping safeguard duties. All these duties are not covered under advance authorization benefit. So if you are importing any raw material on which all these goods, all these cess or duties are applicable, you cannot avail the benefit of this scheme. Now, just to give you, these duties are primarily applicable to silk products. Giving an example, I can say tobacco. On the tobacco manufacturing, NCCD, National Calamity Contingent Duty, or education says on this is applicable. And there are some goods on which anti-dumping duty. So there are some countries, if you import from these specific countries, on that there will be anti-dumping duty or safeguard duty. If you are importing such product and there is application of these duty, the exemption is not extended to you under this scheme. Now, what are the imports being allowed under this scheme? All your raw materials are allowed. Also, with normal wastage allowance. Let's say you manufacture some goods and there is a normal loss, a normal wastage that would be allowed under this scheme. Along with that, if there are any mandatory spares, you need dies, fixes, spares, consumables, that is also allowed, but there is a capping of 10% of the value of authorization. Till that only you can import consumables or spares. Warehouse clearance, so you can clear on a warehouse but valid authorization. Uh, the scheme also provide a very important thing. All these imports, all these goods which you are importing from outside India should be intimated to the customs or DGFT before taking a benefit. And all these should be there on your advance authorization license as a name, description, items which you are willing to import. And along with that, their aggregate CIF value plus what are the goods you are manufacturing which should be exported outside India. All these descriptions should be there on your advance authorization so that they can maintain a log of what you will be importing and what you will be exporting from India. I'll take to the next slide. Now, this slide, which is a very important slide, pre-import condition under advance authorization. Just to give you, this is currently not applicable. This was applicable for an intermediate period from 1st July 2017 till 10th July 2009. But on this topic, there are two contradictory High Court judgments and one Supreme Court judgment. So this is a very important topic. If you want to understand basics of advance authorization, I think this would be a very important. But as of now, this is not happening. So this is a basic caveat for that. So under the advance authorization scheme, the government has made an amendment, wide notification number 79 by 2017, wherein they have brought out a exemption with respect to IGST and compensation cess, which was aligning with EPCG. But they have brought out a condition, which was pre-import condition. Pre-import and physical export of goods from India to outside. That physical export condition is okay. We anyhow export goods physically from India to outside. But a pre-import condition is a very important condition. And this term which they have used has reached out to Supreme Court as well. And then they have came up with their own clarification. And just to give you, the Supreme Court verdict was in the favor of the government, so in the favor of government act. But there's one favorable judgment by High Court in the favor of SSE and one in the favor of government. The government has gone against the Gujarat High Court judgment, which was in favor of SSE. So as of now, this judgment clearly call out what was as a condition as correct. Now, what is a pre-import condition? This is a basic gist. Pre-import condition says goods imported against a specific authorization had to be used for manufacture or production of goods for final goods for export, fulfilling export obligations. Now, simply I will say all your raw material which you have imported under the scheme had to be physically incorporated into the final products manufactured in India, and then they have to be exported. So if you want to take a benefit of this scheme, you have to first import the raw material, use it for the production of your export goods, and then export outside India. So it had to be one-on-one linkage. Now, theoretically, this condition looks okay if you, but practically on ground, let me give you a fair example, which was quoted in the judgment as Gujarat High Court judgment. Now, being an exporter, I have taken a contract from a vendor or a customer who is situated outside India. I'll take an example of, let's say, France. And he has given me an order to manufacture X product within 3 months of the date. Generally, 3 to 4 months, I can say safely say 3 months. Within 3 months, I have to do a manufacturing and then I have to export these goods to France. So this is a simple order. Being an exporter, I have got. Sorry. Now, this condition says you have to first import these goods if you want to take a benefit under this. Now, I have imported some raw material from, let's say, Vietnam so that I can use it. Now, I have placed a contract to Vietnam, which evidently will take 2 months to come to India. Sorry. So I placed the order for raw material, which approximately takes 2 months because they also requires a manufacturing time. Similar like me, they also require a manufacturing time. So I'm taking a very lenient approach of 2 months. In case of mine, I've taken a 3 months for exporting to outside India, but I'm taking okay, the Vietnam supplier will supply me a raw material within 2 months. Let's assuming 2 months the goods have reached to India. For custom clearance, it'll take a week or so. I'll take a week. It may take a 15 days or if it doesn't go into any litigation phase, but I'll safely take a week or 10 days. So now 2 months, 10 days, I've received the raw material. How much time I've committed to the exporter? 3 months. So I'm not within 20 days, I have to manufacture the goods, I have to procure other goods, I have to do all the packing, I have to do the quality check, I have to do all the things, and my manufacturing time has been reduced. So on ground, various exporters were facing actual issues with respect to this condition. They were saying we are not having so much time to prove that all the raw materials have been indeed imported from India, imported outside India to India, and they have been used in, because it's generally been on a circle basis goes on. You manufacture the goods, you place an order for the import of goods, and you manufacture the goods. It takes a little time on that. Sorry, just give me a minute. Sorry for the inconvenience. Um, Now, this issue has gone to Gujarat High Court. Gujarat High Court, considering the SS's actual issue, has came out saying that the pre-import condition is an ultra virus and it exceeds the legal authority. You cannot put a condition on exporter to first import the goods and then manufacture it. It cannot be feasible on ground. On a book per se, it can be correct, but on a ground, it cannot be feasible because you don't have an actual time to manufacture. In my example, I've taken a very less time, which is 2 months. In case the raw material reaches 3 months, how would you fulfill your export commitments? You don't have a time for that. So they ruled out that peak import condition is arbitrary and ultra-virus. Now, Madras High Court has taken a different stance. They have upheld the validity of free import condition. They have supported the government position by saying free import condition is legally valid because they say in a normal BC, in a normal scheme, you were having a custom duty value. Now, to get the IGST benefit, you have to satisfy some additional conditions, which as an importer you have to comply. You cannot take a unnecessary or unconventional benefit unless you are able to comply with the condition with respect to exemption. And same thing has been upheld by the Supreme Court. Now the government, because of the contradictory view by Gujarat High Court, they have gone against this judgment before the Supreme Court. The Supreme Court overturned the Gujarat High Court ruling, upholding that the validity of pre-import condition. So the government's condition in the law was correct. There is a distinction being between the treatment of BCD and IGST, justifying the separate treatment of these devices. So just to tell you, in my scheme earlier also, from the starting, the BCD was always exempted. All your custom duty was always exempted. In respect of IGST, there was a pre-import condition. So they said there is a distinction being made under the scheme with respect to treatment of BCD and IGST. You cannot equate that by saying that for BCD there is no condition for importing first and then manufacturing. For IGST only, this condition was brought down. So they said it can be a different rate. They emphasized that the pre-import condition serves as a legitimate purpose in preventing misuse of duty exemption. So just to tell you, the Supreme Court has always said that very categorically for exemption notification, you have to read very strictly. Now, what do you mean by strictly? Or whatever condition has been prescribed with respect to availing the benefit for exemption has to be complied. Same stance the Supreme Court has taken that for exemption, they are preventing the misuse. They are preventing the misuse of exemption, and they have came up with a pre-import condition. And as a assessee, you have to comply with this unless you will not be able to claim the benefit of this scheme with respect to specifically IGST and compensation. BCD, anyhow, this scheme was always giving the benefit, which is till now is available. But for IGST and compensation cess, there was a dispute for the period July 17 to January 2009, which is now being clarified by Supreme. Also, they have said DGFT has the authority to implement the pre-import. So DGFT has a power, has a responsibility or authority to implement this condition. Now I take to the last slide of my presentation. General provisions. As we have understood that what is the EPCG scheme, what are the conditions, who can avail this benefit, what is the compliances have to done, what are the documentation. Then we have gone to advanced authorization. What is the difference between EPCG and advanced authorization? What is the benefit I am available? Pre-import condition. Now the last slide says validity. As we have seen in case of EPCG, which was valid for 24 months, advanced authorization is valid for 12 months from the date of issue. So within 12 months of the date of issue, you have to import these goods, and then you can get the benefit of basic exemption with respect to basic customs duty. Further, in case it's a deemed export and the project duration is more than 12 months, then whichever is longer, it can be 12 months. So maximum 12 months, maximum your duration. If it's a continuous project, then you can get it for more months. But in a normal timeline, it will be 12. How can I file the application for advance application? So there is an online application in Form ANF 4A, which as an exporter can file on, on, a, on a portal to regional authority with all the supporting documents as per Appendix 4. So Appendix 4E provides all the documentation in respect of application to be made for advance authorization, and that can be filed to a concerned regional authority by a post. Exporter, we have seen that in EPCG there is a bank guarantee requirement, but on the basis of AEO that can be withdrawn or that can be not be required. But in case of advance authorization, there is still a requirement for bank guarantee and LE. So we have to be very mindful of getting, if you want to avail the benefit of advance authorization, we have to provide a bank guarantee, either a LE. Further, the regional authority will endorse the BG and LET on the reverse of the advance authorization. On that only they will provide the details of the bank guarantee. Now, advance authorization should contain the name, description of item, quantity, CIF value, FOB value. All these details should be there on your advance authorization license, so that if any custom officer or any officer wants to check what are the raw materials being you are importing, whether you are eligible to import all these goods or not, whether your 10% threshold of which I have mentioned, mandatory shares have been complied or not. All these details we can check from advance authorization licenses. Further, you will provide a tentative amount of the goods to be exported and CIF value for that. Now, advance, there's an annual compliance under the advance authorization is also there, which every person who is registered under this had to comply within 2 years of export from. Now, this scheme provide a standard input-output ratio, which is CON. On this basis, which the government has provided basis a industry-wide ratio. The standard input-output ratio, which is, let's say, for production of X product, this much is the raw material will be required by the industry. On the basis of that, a standard ratio is provided to all the industry players who are operating. There's a standard in this also, there is an export obligation, but it also depends upon standard input output ratio. Now, in case of defense, if you are in the business of defense and aerospace, you have to fulfill the export obligation within 24 months. And in case of a deemed export, will be required to be fulfilled within the contract execution or 18 months, whichever is probably lower, 18 months, I can say. So this is the basic background with respect to my EPCG scheme and advanced authorization scheme. I have covered most of the aspect of EPCG and advanced authorization. Thank you. I can take some of the questions probably. So I think one question is there: what is the covered in same and similar goods for EPCG values? So same or similar goods. This terminology, similar goods, is being provided under the custom law as well. There is a valuation rules under the custom law. This similar good, what is the same and similar good, has been provided under the custom law as well. I think we can refer the same definition under the EPCG scheme as well. Somebody has asked a question: any time limit for RA to discharge the EODC? I don't think so. There is a timeline for discharge of EODC. So I think I have clarified you. Once you have fulfilled your export obligation, the authority is required to give you a certificate, which is export obligation discharge certificate. Then I don't remember, is they have any timeline for them to give you a EODC. I don't remember this. Composition supplier can avail EPCG. No, first, this is not, there is no differentiation with respect to composition supplier. If you are an exporter and you are exporting goods from India to outside India, then probably you can export, you can avail the benefit of EPCG for capital goods and for advance authorization for raw material. So there is a completely difference. There is no differentiation between composition supplier. I don't think so. So I think there is one request for PPT. I think will be uploaded on the Taxmann portal. Average obligation, to be very specific, average of, you have to first consider the export obligation, which is, I believe this is for EPCG, which is 6 years. Average obligation, yes, but majorly they looks upon EPCG export obligation, which boils down to your block, which is for first 4 years, you have to fulfill 50%, and then for rest balance years, which is fifth and sixth, you have to fulfill the rest amount. So penalties, to be honest, I have not covered interest or penalties because the objective here was to give the background of both the schemes, not to cover interest and penalties. Because recently we have seen with respect to non-fulfillment of export obligations, the government has came up with the amnesty schemes. We can use that amnesty scheme for at least saving up on interest and penalties. So the objective of this webinar was to give a basic, complete understanding of the scheme, irrespective of interest and penalty, because that changes up and they have a timeline for this. So that was the basic. I can say that. That's the reason I'm not gone into that. I think I've covered most of the questions. Uh, I think I can. Hi, Taxman team.
Yes, sir.
Yes, I think I'm almost covered the timeline which is allotted to me. I think we are just 3 minutes, but I've covered the topic very, I think, completely. I can say thank you to all and thank you to Taxman team